Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding Podcast, sitting next to the portfolio manager, the man, the myth, the legend, Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It is going great. What an intro. We hope it's going great for everybody else as well. Hey, if this is the first time that you are checking in with us, be sure to hit that subscribe button, thumbs this video up, leave us a rating and review, check out all of our content. All I want for Christmas, as we're coming to the end of 2019, is a rating and review. We put out a lot of free content. We have a lot of fun doing it. We all learn together. And if you want to pay us back in any way, you can do that by leaving us a rating and review, as that does go a very long way. Also, be sure to check out focuscompounding.com, which is our investing idea website. It's a community of like-minded investors that typically invest in overlooked stocks. Geoff is the one that contributes most to the website. He writes probably about 2 to 3 different ideas a week on going over a bunch of different stocks. They are all overlooked, and then other members as well contribute to the website as well, so it's a ton of fun. So be sure to check that out and join the premium side of things, focusedcompounding.com. In today's podcast, we are going to be doing our 5 stocks snap judgments. Say that 5 times fast. It's a bit of a tongue twister. I think it adds a level of practicalness to the podcast. It's a lot of fun. A lot of people like it. So we're definitely going to revisit it. If this is the first time that you have listened to us doing this, we use quickfs.net. That is quickfinancialstatements.net. It's just a quick snapshot of the company. It's a lot of fun, and it's what Geoff and I use every single day. And the first stock we're going to be going over is Lotus Bakeries. OTC, ticker LTSSF. The last was the market cap of it is about $2 billion. Now this is this trades in the Netherlands, so I don't know if that's $2 billion US dollars. I mean, it says display currency is USD. But Lotus Bakery provides various snack products in Belgium, France, Sweden, and the Netherlands, France, and the United Kingdom, and internationally. The company offers biscuits and cakes. Sounds something that we would personally like. Ice cream, caramelized biscuit spreads, and sounds like they pretty much do all that. They were founded in 1932, and they're headquartered in Belgium. So interesting company. Current PE is 26 times. EV to free cash flow, 76 times. 10-year median margins for gross profit, 41%. 10-year median margins for EBIT, 13.5%. Currently trading at a EV to sales of 3.3. Revenue, we have a 10-year CAGR of 6.2%. And an EPS 10-year CAGR of 10.7%. Revenue in 2009 was $381 million, and in 2018 it was $633 million. Looking at the gross profit, in 2009 it was actually 66%, then jumped up to 68% in 2010, but now it's about 40% in 2018, so that's something that I would definitely want to take a look at. 10-year median returns for return on equity, 20.5%, and return on invested capital about 16%. Thoughts on this business?
Yeah, so I would guess it's an accounting thing. The fact that in the early years that we're seeing, there was a gross margin in the 60-some%, and then it dropped to like 40. Probably an accounting adjustment, because they're probably using IFRS, and it's more likely that they'd have some. It's more likely that I'd have to look more into how they're calculating gross margin in past years for that versus GAAP. But in terms of the years since then, the last, 5, 6, 7 years, it looks very normal for a big food company. So the only thing that's interesting about it that way is that the growth rate is really high. So like if we're looking at this, we're comparing it to Kraft or something like that. Yeah. It looks very normal on that kind of thing. It has a gross profit margin of around 40%. It has an EBIT margin of around 15% or something. Those numbers could be each like 5% lower or something for a food company, but in that range, 35 to 40% and 10 to 15% EBIT margin or something is normal. We could compare it to a lot of cereal companies, soup companies, whatever. You'd see the same sort of thing.
Yeah.
So that's not odd. But what is odd is if it's as big as the market cap and everything says this, as the revenue says it is, and it has those sort of financial results, and it's in developed markets like that, why is its growth rate so high? Now, I know it talks a little bit about energy bars.
Yeah,
and
that's
some other
what I was
things
saying.
like
It provides energy bars and flapjacks, healthy snacks, and breakfast cereal. So maybe they're sort of capitalizing on, I mean, the energy bars. I could see that. But
let's say like the 10-year revenue is up like 6% a year.
Yeah.
We're seeing here. Okay, it doubled in like 10 years. For revenue to go up that much, now there could be currency conversion issues here, but that wouldn't. I don't think that would help them reporting it back into dollars, if that's really what this is in. But I would think that inflation can't be more than a couple percent in the markets that they're in. So that would mean that like units were going up, like they're actually selling 4% more biscuits a year. That seems really high. So, and I should point out, when they say biscuits, it's very possible that they mean it in the British sense. So what Americans would call cookies, probably.
that's what I figured.
Yeah. But still, we're talking about, I don't know why it would grow that much. So it's interesting. But most of the companies that are similar to that.
Let me see what the logo looks like on this company.
You think you've seen
Is that
it before?
Lotus? Is that what they always give away on airlines? Like the special biscuits, you know?
Is it?
I don't know. Doesn't it look like that? Maybe not.
I don't know what they give away.
It is. Those things are incredible. That is what they give away. You know, on airplanes, like Delta, I know gives it. American Airlines.
Maybe
gives that
they do.
away.
I
Yeah.
fly Southwest, so
Yeah,
they don't give that
Yeah, they
away.
do. See, I knew I recognized.
Okay.
Yeah, I remember being. Yes, I
So
remember
maybe
being
that's
so
the
young.
key, maybe that's the key, that they're all given away on airlines.
There you go.
Maybe it could be. I don't know this brand well enough. I recognize, but when you show the logo, I recognize that it is a logo that I've seen before. But I don't know. So we would have to learn about it. It gives a bunch of the different.
Return on invested capital has
brands.
been pretty stable.
Yeah, and what you'd expect too. So return on invested capital is double digit, but between 10 and 20% or something. I mean, these numbers are all very, very similar to what you'd expect for any big packaged food type company, or like sort of like a bakery company. But there are some that are better than that. Like we looked at Hostess Brands or something.
Yeah,
that's a little unique what it has, or McKee Foods or whatever. Those are a little different and probably have somewhat better economics than this. Just because like the price per unit of what they're actually doing is incredibly high. They're sold in really small packages, you know, like as a convenience sort of thing. And this probably isn't sold like that. But it's interesting. It's not cheap though, right?
no.
So EV to sales that we're seeing here is 3.3. That's not unusual. 3 is a number that I see a lot for.
And we'd want an
companies.
EBIT margin of at least, 30%. 33%,
Yeah.
like the average, I guess.
Now, in terms of their growth, it's fine. It's not overpriced, really, compared in terms of their growth. Because historically, a food company could go for 3 times sales, EV to sales, if it was growing as much as they are. I mean, this company seems to be growing as much as the overall economy, if not even slightly better in the European markets that it's in. So, I mean, that's very interesting. It's growing at the sort of rates that food companies grew 20 years ago or something, but haven't been growing lately. So it's interesting. It doesn't look obviously cheap, but if you had to buy something in of this industry, I guess would be something I'd definitely look at.
Yeah, definitely take a look at. Next company, Wabtec Corporation, ticker WAB, market cap $14.5 billion. Let's see, technology-based equipment, systems, and services for the freight, rail, and passenger transit vehicle industries worldwide. Let's see, current PE 65 times, current EV to free cash flow 85 times. This definitely looks cheap, doesn't it? That's a joke. EV, let's see, EV to sales 2.7.
That's not bad, though.
No, that's not bad. And 10-year median margins on EBIT about 15%. 10-year median returns on return on equity 17%, return on invested capital 14%. 10-year CAGR for revenue about 11%, going from $1.4 billion in 2009 to $4.3 billion in 2018. Let's see. The 10-year median margins for gross profit is right around 29%, which has been pretty stable. It's ranged from 28 to, it looks like it had a peak of about 32 in 2015. But pretty stable business. Free cash flow, 10-year CAGR about 5%, EPS about 9%. Thoughts?
Yeah, so just read the very last sentence.
Let's see. Where we at? Wabtec Corporation was founded in 1869 and is headquartered in Pittsburgh, Pennsylvania.
Right. So this is Westinghouse Air Brake is what the original company is. I'm sure that's what the WAB part of it stands for. So it's a very, very old company based on some key inventions that were huge in the railroad industry and changed it in North America. And they have a very strong position in that. Now, all the stuff that we're seeing recently is a little different because they've now, and they're very heavy in North America and very heavy in freight. What they're in now, though, is going to be more diversified because they acquired GE. I guess they call it GE Transportation.
Yeah.
Yeah. So they acquired GE's the business that serves locomotives and stuff. And that will have more freight, more transit stuff involved with it too. But it'll also just be more around the rest of the world too, I think. And so the reason why it might be something that people who are interested in overlooked stocks and that sort of thing would be interested in, it's kind of a spinoff in a way, because basically GE owned the company that Wabtec took over, and GE had some of it go to shareholders as a spinoff, basically, and some of it be GE itself, which is an overhang of stock that will probably be sold off over time and stuff. Actually, I think there was an agreement where they have to sell it by certain dates. So it's kind of like that. What ones have been similar to it recently? Maybe Entercom, because Entercom took over CBS Radio and they did like a reverse Morris Trust or whatever, that sort of thing. The same kind of category as that. So it's kind of like thinking about a spinoff. If you're interested in spinoffs, this is the kind of thing that you could look at. Very big company though. What's the market cap on it?
14.5 billion.
Right, and then it has a bunch of debt too on top of that. And I think it's 2 times debt to EBITDA, a little bit more than that.
It's the type of company that you do lever up, right?
Yeah, so I think it's mostly levered up just to do acquisitions, but it would be fine to lever it up. It is cyclical, but it's not nearly as cyclical as the overall rail industry. We can see, because we have in front of us, return on invested capital over the years. It's been basically in like the 10 to 20% range for most years in the last 20 years or so. And it actually has grown quite a bit too, but that's through doing kind of these tuck-in acquisitions that they do. It's definitely compounded its value very nicely over the last 20 years. I'm sure the stock has. I mean, we don't have a stock chart in front of us.
65 times earnings, though.
Well,
Betting
that's
a lot
complicated.
Of future growth, right?
No, I don't think those earnings are accurate. Got it. So I've looked at some things about what they talk about. Even their EBITDA is a little interesting because they do a like adjusted EBITDA thing. Or they do EBITDA. I think they call it adjusted EBITDA.
How many words does it take for them to define
Well,
EBITDA?
that's the interesting thing. They don't adjust out some of the deal expenses. So almost every company that I've seen adjusts for the deal stuff by saying like they'll when they have their EBITDA, they don't include in it stuff that has to do with sort of like, for instance, they did a previous acquisition a little while ago where they acquired a company that was bigger in Europe. And what was interesting is they had some cash charges associated with like a lot. And I thought, does this mean that they're like firing employees in Europe and stuff and having to pay severance, which might have been it. If that is what it was, they weren't taking that out of the EBITDA they were talking to analysts about and stuff. Now, I'm sure analysts can adjust for all that stuff themselves, and they give guidance on what the future will be and whatever. But I just mean they're fairly conservative on those kinds of measures. The reported earnings obviously could be really messy because of this huge acquisition. It really is similar to, Entercom's more extreme because CBS Radio was actually quite a bit bigger than Entercom. But if you look at it, this is almost a half and half deal. Depending on how you look at it, like in terms of profit or versus revenue or something. Maybe there's more profit in the Wabtec, but it also depends on the cycle, where we are in the cycle. But at worst, it's like they acquire something that's a third of the business now. At the most, it's more like half, right? So it's a huge transformative acquisition. It's like a merger of equals sort of thing.
Interesting.
It has a great position in terms of the installed base and things like that. So I would actually be very, very interested in this company. Doesn't have a low beta, doesn't have low share turnover, isn't really overlooked. Everybody knows the stock.
Yeah.
So I don't know about all that for us. I also think it's probably a good point in the cycle because I think that they'll earn higher returns on capital in the future.
If you look at return on invested capital, it's kind of at the lower end the past couple of years. Mm-hmm.
And I think it's not bad in terms of those sorts of things. They have a very, very high market share for some aftermarket stuff. So not just air brakes and stuff, but other things too. So I'd be very interested in them and to learn more about them. Yeah.
Interesting. Next company, Meritage Hospitality Group, ticker MHGU, trades over the counter, market cap $125 million. They operate quick service and casual dining restaurants. The company operates restaurants under the Wendy's, Twisted Rooster, Crooked Goose, Frighter's Eatery, and Taproom and Wheelhouse Kitchen and Cocktail brand names. Let's see. They're headquartered in Grand Rapids, Michigan. Current PE is around 10 times. We have 10-year median returns of return on equity around 30%. Pretty good returns. 10-year median margins on EBIT about 4%. EV to sales 0.6. So we'd want at least in the neighborhood of 6%, which I guess that's kind of kind of close to it. Revenue, we got a 10-year CAGR of 23%, going from $58 million in 2006 to $435 million in 2018. That is some massive growth. But if you look at 10-year CAGR in assets, that's also about 21%. So it's been kind of in line with that, which kind of stands out to me. Gross margins for the past, I would say, since 2012, they've been in the 40% area, pretty stable. Let's see. Yeah, any thoughts on the company?
Sure. So I had you read the last line with Wabtec to clear something up, that it's Westinghouse air brake. Here, let's explain what, for everyone, in these business description, what does quick service mean?
QSR, quick service restaurant. So literally, like, I think of like Chipotle, think of Wendy's, think of
everyone in America calls it fast
McDonald's,
food, except for investors in the industry that calls it quick service.
Yeah.
And casual dining.
What's your favorite QSR? Chick-fil-A, and it's not even close.
I like Chick-fil-A a lot.
Chick-fil-A.
Yeah. And casual dining would just, is basically some form of low-end restaurant that isn't a quick service restaurant.
Yeah.
So I assume these are mostly Wendy's. Right?
Yeah.
I assume these are overwhelmingly Wendy's.
Yeah, I'm sure.
So
I've never heard of Twisted Rooster.
Right,
or cooked goose.
But here's the thing: some of these we have heard of some things here in Dallas-Fort Worth area that they haven't heard of in the rest of the country, and they will if it expands beyond it.
Yeah,
including some things that have been acquired by other companies and stuff.
It operates 332 restaurants in Arkansas, Connecticut, Florida, Georgia, Indiana, Massachusetts, Michigan, Missouri, Mississippi, North Carolina, South Carolina, Ohio, Oklahoma, Tennessee, Texas, and Virginia.
Right. Most of those states being places where if they had concepts, I wouldn't know much about them.
Yeah.
So I'm going to assume that it's mostly Wendy's, which could be wrong.
Probably.
So I don't know how else they would grow that fast with acquiring things, because they're clearly acquiring things. So we could just go over some of this stuff. So their asset growth is way too high. So we can just tell some of these things. So if return on invested capital says it's about 8%, there's no historical free cash flow generation at all. Assets have gone up 21% a year?
Yep.
And revenue about the same amount.
Yeah.
That stuff probably tips you off to they're acquiring stuff and they're doing it using a lot of debt. Are they using a lot of debt right now? Let's see. So price to sales is,
It's a little bit.
Okay.
Price to sales is 0.3, EV to sales is 0.6.
It seems like a little bit, but let's think about these. Do they own the restaurants and the underlying real estate? Probably. If you're a McDonald's franchisee, do you own it or does McDonald's own it?
McDonald's.
Okay. So they're probably using a lot of debt, I'm assuming, and on top of having leases. It could be wrong. Maybe they're using a lot of debt and they own things outright.
Value really quick.
But, okay. But I just think that if they're doing that, then it's a lot more leverage than you might think. And so then it's very, very leveraged to things like same-store sales stuff. Also,
the market cap, 125 million. Enterprise value, which of course accounts for debt, 621 million.
Okay.
Debt to EBITDA, 12 times.
Right.
11.81.
But that might be because of the recent accounting things
with
about
the leases.
Yeah. I don't know, but I'm assuming that because I don't think they have 12 times financial debt.
Again, this is just a snap judgment. We know nothing about the business.
So there's a few things. So first of all, I would use EBITDAR. So earnings before interest, taxes, depreciation, amortization, and rent. Yeah. And I would use leases there. Okay. So
earnings before all your expenses.
Or before all your expenses. Yeah. But I would add back your leases to it.
Yeah.
I would definitely do that when looking at something like this. And that's what they have to cover. But the other thing is with the free cash flow, if you look at it, that free cash flow looks very low for a restaurant company.
Sure.
What that probably means is they buy things and then they put in unusually high amounts of CapEx, just a guess. Or they actually build them. So if you build a new restaurant, then that would have a lot of CapEx. Your free cash flow, the way it's calculated here, would look poor. Also, if you took over an underperforming one, and you refurbished it or something, same thing would happen. So if they're either taking over underperforming stores and then refurbishing them, or they're building completely new ones, this would happen. The way free cash flow is usually calculated on websites, if they were acquiring things, it wouldn't show up that way. So this is some sort of roll-up.
Yeah. Which normally, we've been asked that before. If a company is very acquisition prone, do you account for that as CapEx, essentially?
You have to. It's clear. Like here, just start with what was the revenue in 2006?
58 million. Yeah, you could tell.
Okay, and what's
jumped like crazy?
What is it in 2018?
435 million.
Okay,
That's
so it quadrupled.
Yeah, massive.
So
growth.
in 10 years,
it's grown 23%. 10-year CAGR.
Okay, So I didn't have to do that. That's good.
I did that in my head.
Very, very impressive. So you could have figured that out though using the rule of 72 and all that.
I like to do the easy way, just,
looking at what it says. Yeah, but just so people know why I was doing that. So I quadrupled in about 10 years. So I'm sorry. Yeah, no, more than quadrupled.
10-year
It
median
increased
return
eightfold in 10 years.
for return on equity, 30%. That's pretty impressive.
Is it impressive?
But how much is the acquisition pro? I mean, because we
can do the math. The return on assets was 5%.
Yeah.
The return on equity is 30%. So that means using 6 times leverage on assets. Now, some of your assets were funded by working liabilities, basically. So your return on invested capital was 8%. Excuse me. If your return on equity is 30% and your return on invested capital is 8%, then we're talking about what is that? About 4 times leverage that you're normally using, which sounds about right. So yeah, this is a financial engineering thing. Mm-hmm. And if you believe in management and you like the things that they're acquiring, it makes sense. There are potentially things that are very safe that way. One thing to keep in mind, if you have same store sales going in the right direction, it works out great. If you have same store sales going in the wrong direction, it works out badly with these things. So because that leverage, that operating leverage is very present in all restaurant companies that don't use debt. Mm-hmm. So if you put debt on top of that, then the same store sales stuff becomes incredibly important, and any negative trend in it, you have to watch it very, very carefully. Now, a positive trend can mean great things. If you have a great operator taking things over, improving them, or building new ones, and then having great same store sales, that could be a big success. It's going to be very messy, hard to figure out from the financial statements. I'm sure people are looking at it on adjusting it for probably using EBITDA and stuff like that, and building out a whole model for it. It'd be interesting to look at that way. This is the kind of thing that it excites a lot of value investors and doesn't really excite us usually. We're not usually that confident in management doing this buy and build thing and this sort of thing. We get asked about it a lot. And we're usually not that confident using a lot of debt, especially debt on a company that also has leases. I'm assuming this company has a lot of leases and debt both. Got
it. Next company, Synergetics Inc., ticker CTEK, market cap $28 million. What do they do? A cybersecurity company provides various services and solutions to help organizations in achieving privacy, security, and compliance goals for healthcare industry. Current PE, 2 times. Mm-hmm. EV to free cash flow, 3 times. 10-year CAGR on revenue, 13%. 10-year CAGR on free cash flow, 18%. Gross profit, 10-year median margins, 19%. EBIT, 10-year median margins, 1%. And return on equity, right around 4.5% for the past 10 years. Revenue, as I said, 13% 10-year CAGR, going from $16 million in 2009 to $71 million in 2018. Looking at the gross margins, it looks like it dipped down from 2009 at 25% to 2012 of 13%, but then it's been on the rise ever since, now at 29%.
Changed its name in 2017. Can you get me, if you go up to the statements thing where you can pick out where you want to go? Yeah. Can you click, no, that one, the overview thing. Can you pick that, switch that one to something that will show me shares outstanding? Will key ratios do it? Will balance sheet?
Let's see, maybe key ratios.
Okay.
Free cash flow, no.
A diluted share.
What? Where? I'm looking with one eye.
Okay.
This mic is, there we go. Here we
shares. Go. Yeah.
Diluted shares. Okay.
Okay.
So year-over-year growth.
That's puzzling to me.
Tell me what you're seeing.
So I'm seeing that it grew for a while, and then it hasn't grown that much. Now, it still has grown a lot. Let's not get this wrong. It's grown way too fast, this diluted share count, for a company that I would ever invest in. However, I still don't understand, if we go back to the main page, I still don't understand the things that I'm seeing here. So if we look, I'm seeing a 10-year CAGR in, take assets. That's a good one to take.
21%.
21%. What is the return on equity?
Return on equity, 10-year CAGR?
Yeah, 10-year
median margin, 4.5%.
And that's the highest of any of them, because that includes debt stuff, because if you look, return on invested capital, return on assets.
Yeah, it's very messy.
So how do you do that? I see that the enterprise value to sales is lower than the price to sales, so they don't have debt. How did they increase their assets and their revenue by that much without increasing their share count by that much when their returns are so poor? Mm-hmm. Don't know. I don't know if there's something wrong with the data, if I don't understand things, if they issued a lot of stock when their stock was expensive, and that's how they did it. But it had to have come from funding it just has to have come from funding from shares.
Shares diluted in 2009. It looks like, if this is in millions, it is. Yep, 6 million. And in 2018, it's 10 million.
Yeah, the question is just how much they got from that. We could actually see on the cash flow statement if you can do that really fast. I don't know if you can. So you can actually see it inflow from issuance of stock. Where is it from?
Net issuance of common stock.
That's not right. So I don't know. There might be something wrong with the data and stuff. It's not interesting to me issuing way too much stock over time, but I don't even with that, I don't know how they grew as fast as they did if their returns are really that low. That could be inaccurate that the returns are that low, but I don't know.
Interesting.
Yeah, they changed their name. Just nothing about this would be something that we would look at.
Last one.
Okay.
Something that we were customers of. I put this one up there because I thought it'd be interesting to talk about, and because I think a lot of people will be familiar with it.
Okay.
Value lining.
Yeah.
Yes, they are a public company. Those big old books, a value line. Ticker VALU. Market cap is 267 million. I think everybody knows what Value Line is. I hope so. They sell investment, publications and stuff like that. Obviously, go to your library. They have them. I have the small cap one that I ordered a couple years ago.
Oh.
So that was fun. PE ratio currently trading at 23 times earnings. EV to free cash flow 21 times. 10-year median margins on EBIT 6.4%. EV to sales is 6.5%. So we would want 65% EBIT margins, essentially. Let's see, what else? 10-year median margins for gross profit, 84%. Obviously very stable. And they used to actually be better. 10-year CAGR for revenue, negative 6%. Going from 58 million in 2010 to 36 million in 2019.
Yeah, although
guys like Focus Compounding are putting them out of business.
Although they shrank their assets too, which is good. So
yeah.
a 10-year CAGR that has shrinking assets is nice to see. I love the product. My favorite podcast ever used the product.
Yeah.
And then they complained to them and they stopped using it.
If you know why this company's done bad, that's why.
Yeah. They have a... Yeah.
Let's see what the stock's done.
Yeah.
Keep talking.
Okay. So, I don't know. This one's a little complicated. We use this kind of product, so it gets like a little bit more complicated in terms of what we know about it. There are things about the culture Value Line that worry me, to be completely honest.
The family?
No, I'm not going to talk about that.
The stock's actually done quite well. It looks like it
was a very cheap stock.
In 2015, it was $12.30. Now it's $28.
Yeah. So I think they're very aggressive about squeezing every last dollar of what they have. And
you think their product's expensive?
Yeah, they have an 82% gross margin.
Yeah.
They had it when they were mostly a print company. Yeah. I think it's expensive, but I think it's worth every penny. Sure. The Value Line investment survey, the small cap one is not that great, but the actual printed out one and stuff, yeah. Yeah, and in terms of what people could learn from and stuff, getting the printed out one getting mailed to you every week or whatever, so that you cycle through everything every quarter, I think is way better than using a site like Guru Focus, Morningstar, any of those sorts of things. We're using QuickFS right now. To look up things is fine, but like as a thing to be aware of all stocks and to have time to go over 5 minutes with each thing like that, it would be a great habit for people to have. I think it's great. I will recommend their product. I will not recommend the stock.
Would not recommend the stock. Out of all the 5 stocks that we took a look at today, Lotus Bakeries, Wabtec Corporation, Meritage Hospitality Group, Synergetics, and of course Value Line, which stock would you be most inclined to do further research on?
Wabtec.
And why is that?
I think it's the best business with the best future.
Best business, best future, not overlooked.
No.
Not overlooked. I want to thank everybody so much for tuning in with Mr. Geoff and myself on this 5-stock Snap Judgment podcast. Of course, this is a Snap Judgment. If you know the business more than us, you probably should. But if you want to update on us or send us stuff, send me an email. info@focuscompound.com.
Yeah, talk about any of the stocks we talked about.
Yeah, that's the best part about doing this is a lot of people generously send me emails on kind of their due diligence on the stock. Of course, like I said, because it's just a Snap Judgment. But I want to thank everybody so much for tuning in with Geoff and myself. Be sure to go to focuscompounding.com. On the homepage, sign up for our email list, a weekly or bi-weekly, we haven't decided yet, email list that goes out. We give out a free idea, and then we also talk about the stocks.
Get a free write-up, the whole thing.
Yeah, free write-up.
Like 2,000 words or something.
And we talk about the stocks that are written up on the website, and we also give a revisit price of when we will like to revisit the company in the future. And most of the time, obviously, that's if the stock falls. But I want to thank everybody so much. Make sure you hit that subscribe button, thumbs this video up, leave us a rating review, and we will see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.